My guest today is Nigel Lee. Nigel is a founder of RBO Group, an Australian permanent holding company which acquires profitable small to medium businesses. Thanks a lot for coming to the Holdco Builder show,
Thank
Nigel.
you for having me.
RBO Group is a purpose-built permanent holding company that specializes in preserving successful West Australian small businesses from owners looking to transition into the next chapter of their lives. As you said, we are not a private equity firm. Our permanent hold approach doesn't rely on accounting tricks and manipulating exit multiples. We are also not an investment fund or finance professionals. We are operationally focused business operators. We understand business drivers and think long term. We get into that very soon. Before that, can you tell me about your background and what inspired you to become an entrepreneur in the first place?
Firstly, I probably took an untraditional path. So completed high school, never went to university, traveled for a period in Europe actually. And when I came back, I met my now wife, 15 years, and she told me to get my life in order and I couldn't travel for the rest of my life like I was trying to in my late teens and early 20s. So I started an electrical apprenticeship. So by trade, I'm actually an electrician. And then towards the end of that, or halfway through, I started to look at business opportunities and just decided that, look, it was a good opportunity that I was in, being an electrician. It was good money here in Western Australia. We were in the middle of a mining boom, and I was making really good money, but it wasn't something I wanted to do for the rest of my life. So I did that for close to 2 years, just looking at a different amount of opportunities. And I was fortunate that the first one that I found and the first business that I purchased was a franchise. And probably two things happened in that journey. So franchising taught me predictable systems and leveraging those market proven systems. And secondly, there were two founders of that business. They both were great. And one of them took me under his wing and really taught me everything foundationally that I know now. And that was everything from just general business concepts to sales, human psychology, behavior, everything that I've now utilized to execute on what we have today. And that journey was great. It ended up taking me to the US. So I operated that business in Western Australia for 2 years. It was an office coffee franchise. And because I was so young, I purchased it when I was around 23, just before my 24th birthday. And because I was so young and green in business and really had no right to own any business because I had no experience or background, I essentially just did everything they said. They said, go left, I went left. They said, go right, I went right. And in turn, that business grew quite significantly over that 2-year period. I was one of their highest performing people in the corporate team and running the West Australian region. So then after that 2-year period, they were looking to expand internationally. So I was in my mid-20s. I'd just been married and they offered the opportunity to buy the rights of that brand and launch it in the US. And that's what took me to New York City. Again, because I had no idea really what I was doing. I was mid-20s and we had a decision to make. It was either have kids or do something like move international and take a chance. And my wife and I decided to do that. So in 2012, October, we moved to New York City. We hadn't never been to the US before, and we didn't even fly there before we went there. So looking back now, it was probably irresponsible the way that we did it, but I think everything happens for a reason. And we spent the next 8 years in New York City. So it was a fantastic time. It taught me a lot and I learned a lot, but we built everything from the ground up, supply chain, partnerships, you name it, we had to build it from scratch. And the only reason we chose New York City was because of 100% of our customer base was offices. And in my head, I said, where are the most offices in the US? And that was New York City, and not knowing what it was and how big it really was. We did that. So by the time we left, we were in 7 cities or locations. We had a plan to open 10 more in 2020. We had 3 or 4 that towards the end of 2019 were already kind of in place to open in that year. And within that, I brought on one small partner, but it effectively bootstrapped it the whole way through, and had done a couple of JVs with corporate just to expand across the whole country from a territory region. And we raised our first round of real capital to be able to really take it to the next level and build towards an exit strategy. So unfortunately, what happened was we did that deal. We had great partners. The money hit the bank account, and 3 weeks later, COVID hit, obviously unexpectedly. So as everyone knows, the office market out of everything definitely ground to a halt. And we went from scaling quite aggressively to basically going to zero revenue. So we made a conscious choice, and there were a few lessons in this why this is relevant, that we really wanted to obtain or stay with most of our customers post-COVID. And at that time, in early of 2020, no one knew what COVID was, and we thought it would pass in a month or two. So we basically said to all customers, even though we could charge you minimum contracts that we have, we're not going to do that. We'll all get through this. I was fortunate that when I built and designed that business in the US, we built everything through third parties. So our OPEX base was quite low already, and we were able to basically bring that close to zero. So our burn wasn't that aggressive. We had some cash in the bank, which was fortunate because we had just raised that round. And yeah, so it was a long stint, and I spent 6 months kind of waiting it out. It obviously didn't go away. I came back to Australia for a small break because I said to the team, look, like COVID's not going away. It's obviously quite difficult in New York City at that time. And then once I got back, I had actually originally sold my wife on 2 years, no kids, and we were there 8 years, and we had a son. So by the time we got back and then we started to integrate a little bit, not knowing when we would be going back to New York City, we had decided that, look, it was probably the time now to stay in Australia. And I was then in my mid-30s. By that time, one of the original two founders had integrated himself over the last couple of years back into the US business with myself and was supporting me. So it was him and myself, and then the new group that had funded us. And we essentially ran it for a little while from Australia, and then I decided to step away. So still on the board at the moment, still a shareholder, but just from an executive position. At that time, I was CEO and running everything essentially. I decided that, look, I was early mid-30s and felt like I was in the prime of my career, and Australia was probably where I was going to be long term. The business now is back to it's actually bigger than pre-COVID levels. They've built it back up. I still believe it's going to be a fantastic model for the US as it was here in Australia. But that was the story, and that's kind of where the whole RBO Group journey started over that 8 years. Was I don't have a finance background, but New York City, and I've always learned it through people and through mentors and being around people who have skills, and that's what New York taught me. It taught me finance. I saw private equity, I saw equities, I saw hedge funds, distressed assets, and one of the big trends that I saw over there that was already happening was the generational wealth shift in SMEs, and where that was moving away from traditional succession planning and into either other individuals or groups like holding companies or private equity. So that's where I first saw it, and then I moved back to Australia.
Okay, maybe a few questions about this period. I mean, growing those businesses, one in Australia, then moving to New York City. First of all, I believe a lot of people aren't willing to move to other cities and maybe even other countries. And then you pretty much having to shutting down all of it. How was the period for you emotionally, where you felt low, sad, something like this? Because I mean, you succeeded. You moved there. Your wife was happy. Business was going well, and then boom, this happened. So how was
I
it?
think for the first period, I was mixed emotionally because I didn't necessarily know how to react, considering that we'd spent all that time and energy and money building it. But I think on reflection now, in my mind, I've come to realize that it was successful, that we had got it to a point where it was going to continue to be successful, and we were dealt a card that everyone was dealt, and we can't change that. So I think I've got to a point where, did I get the exit at the time that I thought? No, but I think, again, on reflection, the skills that I learned while being there and moving internationally, I've always said to people who have asked me, should I do it or should I not? I'm very optimistic and aggressive with this type of thing, but I'll say yes. I think it matures you quickly. You learn a lot. You're put in an uncomfortable environment. I think you're forced to solve problems. And I think it made me grow up very quickly, and I think that was a good thing. And again, I think if I didn't do that, I wouldn't be in this position today. Even if I did sell that business at that time and stayed in Australia and continue to progress with different acquisitions, I believe moving to a country that I had never been to before allowed me to kind of progress in my development, both personally and professionally. And again, it wasn't easy. Like, I describe it as 12 rounds of Mike Tyson every day. Like, you're happy and successful, but you're solving challenges that are very difficult at times. The biggest, probably most difficult thing was building network from the ground up. Like, the first person I knew was the doorman of the building that we moved into when we first got there. So it was a hard slog, and then we had to do things to be able to build that network short term and long term. So
Okay. So now, what about RBO? What was What was the initial thought, how it got
Yep.
started? Maybe you can talk about the first investment, maybe a bit about the structure, and the big elephant in the room, funding.
When I moved back in October of 2020, I didn't start RBO Group straight away. I did a few other things, including some consulting for some other companies and in the tech space. That was fun. It was good. It was good money. But ultimately, consulting is a challenging role to play. Most people that you consult for don't necessarily listen, and then you get blamed either way. So I did that for a period of time. And the catalyst for RBO Group that really came to mind was here in Australia in early of 2022, the public equity markets fell off a cliff. And the people around me, mentors, high net worths, and investors, were all giving me feedback that they were out of growth stocks. They really wanted a long-term dividend yield strategy that was cash flow focused. And in my mind, I was kind of in between, like, what am I going to do long term? And I had the RBO Group structure, and it wasn't called RBO Group at the time. And just in case if anyone's thinking, RBO Group stands for Retiring Business Owners. That's how original I am. I don't like coming up with names, so that was the easiest one to come up with. But so I kind of sat on it for the first part of 22, just kind of seeing what the markets were doing and what everyone was telling me. And then I decided that, look, RBO Group needed to form. And there was an opportunity there, and I did some research around that. And because I'd spent the last 12 or so years essentially building businesses on my own, even though I had support of corporate and others around me, I really was building them on my own. I didn't want to do that again. So I reached out to my business partner, Matt, who I'd known for 20 years. We played sport together and have kept in contact ever since. And he was in a role where he felt like he wanted to do something different, and I was looking to start RBO Group. So we partnered up pretty quickly. And then that was around August of 22 by the time we really got started. And then we spent the next 9 months in market doing what I described as market research and looking at every single deal we possibly could. We had a set of criteria at that time. And it hasn't changed too much. We may have refined things slightly, and I'll go into that in a minute. But realistically, we were looking for our first deal. We had this idea in our head, like you have, and most people that are moving into this space, and really priority in just any goal that you have right then is just get a deal up and the best possible deal you can find. And as we did, we looked at hundreds of deals, I reckon, every IM we could find. And we had a few offers away and a few didn't get up. And then March of 23, we got our first deal locked away. I actually believe we had an offer. We got the offer accepted in 22, and then obviously didn't close until March of 23. So that business was a company called AAQ Australia. They were an Australia-wide automotive workshop equipment business. So they sold vehicle lifts, stackers, tire changes, wheel balancers, and any automotive workshop equipment to everyone from your local car guy who's got multiple cars in his garage and he likes to tinker with them, all the way through to professional workshops and corporate industry. And that deal actually set the tone for really refining what we have today as our set of criteria and what was important. But going back to probably the elephant in the room question about funding. So going back to probably last year, our only goal was to get a deal away and execute that deal as appropriately or as effectively as we could. So that meant that we raised investor money as well as used a traditional debt banknote to fund 50% of the deal, and the equity was raised through investors for the other 50%. So I'll go into a little bit of the platform structure in a minute because it'll explain how we've done deals since. But from that point, what our thesis and our mandate is to date is we invest in retiring business owners' businesses only. So that's a very big line in the sand. We traditionally don't buy businesses off people our age. They have had to have owned them for 15 or more years and they're moving into retirement. There's no succession plan. West Australian headquartered only. We love for them all to be selling nationally, but we want them to be headquartered locally because it allows us to be operational versus investment mindset. Generally a 50-50 product service mix. We started with more of a product focus, and that was probably 80-20. And the reason for that was our belief is that products and systems are easier to scale than people. People have personalities, partners, lives, and the like. We have slowly changed that to a certain degree because there is a lot of good opportunities in the service market, but our criteria still fits that we need a product service fit. It can't just be say, for example, 100 plumbers. We're not necessarily in that line of investment or acquisition. And then the last couple is we are sub 5 million of EBITDA, and we really look below that number, because when you go above that number, you start to bring in management team and operational efficiency, and they're the two things we really are looking for that aren't there. So we're looking for acquisitions that have got to a stage that they're family owned and run, but the next step in the process is to bring in management, and they haven't done that yet. And secondarily, they don't have any systems or processes in place. So where most people would be scared of that, that's exactly what we're looking for. Our execution team has experience in that field, and that's where we find we get a lot of value from what we do is buy well at good multiples and then execute on both bringing in team and systems and processes. So from there, we did that first deal in March, and that story was a 68-year-old. It was himself, his daughter, who had also been there for 20 years, and one installer. He started the business in 1995, and it was just them three when we purchased it off them. They effectively used a phone, an accounting package, and essentially he had a diary that had 1 day per page, and the rest was just done as it was needed. There was no real there was tech enablement, no systems or real deep processes. And that has pretty much been the story of every acquisition since. And I'll skip forward to now. We're in the process now since March of last year, and we're completing deal 8, 9, and 10 since then. And they will be completed at some time in September. And then throughout that period between March and now, we've kind of got a lot more sophisticated in our back end and how we structure deals, both financially and operationally. But I think the general trend was 2023 was execute well within that first business, and Matt and I did that. We then acquired a second business that's called VIP Car Storage, and that was a short and long-term car storage facility locally here, about 10 minutes from the Perth airport. And again, Matt and I jumped into that one and started to execute that well. We really did have a big mandate we built a lot of assumptions prior to our first deal on what we thought was going to be true from an operational standpoint. And we wanted to cut our teeth on that and spend the time to validate that. And we found very quickly that we could find these businesses that were operationally inefficient, that had no management, and we could start to build that throughout and still be successful without really getting too aggressive on marketing, sales, or leveraging up on debt or anything like that. So we had 2 deals done by July, and then the third we had kind of structured by the end of 23, but didn't close it until January of this year. And what we found throughout that process was that once you're in an industry or group, the most important thing, I think, bar none, is distribution, meaning customers. And once you have that customer set, you can very quickly and easily roll up other acquisitions in that same thematic or group very quickly. So those first 3 deals were in automotive or in a category of automotive. So towards the end of 23, that's when we decided that, look, we're onto something here. There's a lot of deal flow and opportunity in this market of generational wealth shift, no succession within the family. And to be honest, we've actually found a couple of deals that the children wanted to be social influencers and didn't want to take over their parents' companies, which we found quite humorous. But I think that's just the day and age we live in, where we're looking for these industrial, boring type businesses. So we decided to talk to a few more advisors that had more experience in private equity and the serial acquisition space. And what that taught us is that we probably had to do 2 things. We had to, one, in 24, not just do whatever was necessary, but build some real structure and systems and processes around our back-end operational mindset. And secondarily, change our capital structure and the way we do things to allow us to acquire quickly and at scale. So yeah, 2024 has been, one, building what we're describing now as our RBO Group operating system. So that's really building a playbook that we can apply to every new platform and portfolio company. And our belief is that probably 70 to 80% of that playbook or operating system is always going to be the same, and the 20% or 30% is going to be slightly different between the nuance of that industry or platform that we built in. So before I jump into how the platform and funding structure works, do you have any questions around that?
Automotive industry. Did you know about this industry before you got into this, or how was it?
Well, obviously I knew about automotive, but no, I would say, I think the premise of your question, the answer would be no. We were always very open to what industry we would go into. I think the only 2 we probably wouldn't go into now is is retail and hospitality, so food and probably fast food and the like. But besides that, we would pretty much go into anything. What has been, I think, interesting in the automotive market is that they're fanatical buyers. They love cars. They like to spend money, and they're very passionate about that space. So it's really allowed us to go deep into that space and work with that customer set. But yeah, I think it's a really good market, and I can talk about the other ones too as we start to go into more of the structure of what we're doing.
You were with Matt discussing about this idea. So what did you do? Like, how did you build a list of companies, or what was the approach to business owners, and what was their response to you?
We went through all the traditional channels that people would think of as one point, so brokers, advisors, and the like. But what I started to think about was, where is the highest level of trust with these individuals that we're really looking after? And just as a recap, they are older people who have been in business for 15, 20, 25 years. And what we came down to was that their accountants probably have the highest trust level out of anyone in their life in business, including their life partner, right? And when they're ready to sell, they generally go to their accountant first and then even talk to their wife or partner. So we started to approach small local accountants. So we wouldn't go to any of the larger groups. We would go to accounting practices that have one or two people total. And we would sit down with them and we would talk to them about succession. So the discussion was always built around, we understand the market. We understand your client doesn't necessarily listen. For the last 5 or 10 years, when you've been talking about succession, they always think they can go forever. And generally speaking, what we found that they were always 1 year too late. So they thought they had another 2, 3, 4 years. And then all of a sudden they decided, look, it was time to go. So we discussed succession at length. And then what we were pushing was that we were that succession plan. So we could move quickly, we could execute. And I think at the first deal, a lot of that was, we had some structure in place, but like probably most people in this, we were always very much like, could we get this up or could we not? And we would do anything to do that. Whereas now we can get pretty much any deal we want away, and we've structured it in a way that we can move quickly. But that had always been the thought process and premise, and that worked amazingly well. So every single conversation we had, every single accountant always had one client that was ready to sell, or that should have been ready to sell, but wasn't moving. So that kind of set the tone, and we got a lot of deal flow. The first deal did, though, come from a traditional broker. And we built a lot of strong relationships then, and still do today. And we still do deals with brokers. We do a lot more of our own deal origination now, and that comes from both that accountant strategy and secondarily just cold calling. So we spend a lot of times, especially now that we have upwards of 10 companies in multiple industrial regions in Perth, we're driving around a lot, and we essentially just drive around, see a warehouse with a name on it, looks interesting, we Google it, and you could be in the car and you could potentially just cold call them from the spot. So we do a lot of that. We are then now also moving into a new RBO Group brand, which will be probably released even before this may come out. And a big part of that is the content play around being the authority in this market, in that space. So we're looking at strategies and execution of what that would look like, and how we can do that effectively.
How was the reaction from the business owners? I'm asking because I've been so far just haven't used those accountants, haven't used brokers. I've been doing my own cold outreach, calling to them, and with zero trust. Obviously, it's pretty hard. But it's doable. You get so much better after doing hundreds and hundreds of calls. So how was the reaction when, for example, the accountant made an intro to a business owner that here are two guys who would maybe one day acquire a business like?
Yeah, great question. So it was tough to start. Obviously, it was me and Matt with an idea. And even though I'd had business experience and Matt had some limited business experience, it was still, who are you and why are you even reaching out to me? We actually did a fair bit on LinkedIn, which actually worked quite effectively. And we were just DMing or trying to connect with people with a short message about what we were doing, and it worked well. That said, I think that the thing that we played on very quickly was, even though we did want to get a deal done as quickly as we could at that time, we always discussed the long-term play versus, hey, let's do something now. So it was, we're sitting here in front of you to discuss the next 1, 2, 3, 4 years, not necessarily saying, I want something from this meeting, and if we don't, we won't come back to you. And I think that built a level of trust that we could work with them over a period of time. And that's the next evolution of RBO Group from this year onwards is that we do now have the structure and time to be able to spend and really work with these advisors, with their customers on when is the right time and can we build into a succession plan that works for them. And we're really fortunate that what we have learned over all of these acquisitions and talking to a lot of business owners is that if you can build that level of trust, we've found the priority set from the seller has been legacy, team, and then price. A lot of these older owners of SMEs really want to make sure that their legacy is kept safe, lives on, and then ultimately their team is kept in place. So we do try to preserve as much of that as possible. And look, it doesn't always work, right? Like some people leave. Inherently, people don't like change, and it's always difficult to bring in new owners. But we are sincere in the fact that we do want to keep as much of that structure as we possibly can. And these are the conversations that we have. And I think a big part of doing that is to build a level of trust before there is an ask. And I think if that happens, you can actually take this strategy a fairly long way.
Before going to discuss the current portfolio, what are your thoughts and how were your thoughts when you got started when it comes to buying any deal just in order to get into the game versus just looking for this golden goose for, I don't know, 5 years?
So I have some pretty strong views on this. I am definitely an advocate of getting a deal away. I think the hardest part of business is actually just getting into business. I think people get into a spiral of trying to find a golden goose and the perfect deal, and they're always talking themselves out of why they shouldn't do a deal. I think the approach that we found that works for us, and again, I want to context this entire conversation with the way that we operate has been based on, and especially for our group, my experience and context on my life, right? So I have a different perspective on that based on that. But from my perspective, we are always looking for reasons to do deals. Now, we do all the DD that everyone else would do. We look at all the risks and everything else, but we're not trying to convince ourselves to do every deal. But if we find a deal and we get an offer accepted, there is always an execution element from an operational standpoint to be able to manage risk. And that's how we assess as we go through DD is this something that should kill a deal, or is this just something we need to manage? Does it change the deal, or does it manage it on the back end? But yeah, so I wouldn't say to get any deal away, but I would say that I think getting a deal away and getting in, and does that mean that you hold that deal forever? Potentially not. But I think that experience will teach you a lot. And every deal that we have done has taught us something further and has therefore built upon our structure and how we execute and what we have done. And like I said, I think I had always had a plan to buy a number of businesses, but in the last 16, 17 months, we will have done 10 acquisitions by September. I sent off another MBO this morning. I've got another one that I want to send off next week. So we are moving aggressively, and it's with that mindset is why we're doing it.
Again, one more question about the due diligence of this first one. You mentioned 3 people, quite a small business, and everything was just on a small diary, on a small piece of paper. So how was the due diligence?
Yeah, so I think what you'll find in this space is that there is no real sophistication, and it's probably the first time that they've ever sold a business. Most of these business operators in this SME space got into it because they were good at what they did, or moved into an area they thought they could execute well, and then accidentally pushed out $1, $2, $3 million of EBITDA over a 10, 15, 20-year period. So due diligence is always more of a pull. We're the ones building the data room. Even if they do have a broker, we have an RFI. We try to help them and handhold them as much as we possibly can. So it is more work than probably what you'll find up the food chain. So if you're doing a deal that's 10, 15, 20 million, I'm sure there's a lot more sophistication structure around that, but you're obviously also paying the price for that. You're paying higher multiples. So yeah, so we're doing a lot more work in that sense. For us, that's what we have found that works for us as well. So we're okay with doing that.
What is the size of the holding company today? How much you can share? Employees, revenue, 8 companies?
Yeah, so it'll be 10 companies by the time we get these last few deals away in September. I think now we have over 50 employees across the group. Over that time, I mean, I'm happy to share some information. I think over that time, we would have accumulated, I think from an LTM EBITDA basis, 7.5 million across those acquisitions. Some are smaller than others. Once we open a new platform in a specific industry, some of the criteria I mentioned before can move. So generally, we don't look for deals that are under 500K of EBITDA, but if we find an acquisition that maybe isn't performing great, but could click into our existing platform. We may move some of those metrics depending on what it is. But I think the one thing in the structure, and I'll talk a little bit about structure because it'll define how we do this now, is that so where we started was that a straight equity investment into an SPV, whereas now what we have is what we call a platform group structure. So that has two holdco entities. One is an investment holdco. That investment holdco is where the equity and debt comes into for a group. We then have an operational holding company, which is effectively a GM of a group that runs those portfolio companies below it, with a potential shared services team, depending on what that company is. And then below that is where all of the portfolio acquisitions are made. So in the automotive platform, there is now 5 acquisitions within that now has its own holdco structure and team, and then they execute within those 5 portfolio companies. Outside of all of that, RBO Group has a shared services model. So we have a team of about 10 now that forms across key executive roles. So that's CFO, CMO, operations, BI and IT, pretty much everything you would expect from an executive level. And the reason we did that early was that all of these SMEs don't necessarily need a full-time CFO, but would obviously benefit from that higher level of experience. So they don't need full-time, but we can plug them across. So what we have now is, and what will be open by September, is 3 platforms in that structure. So the first one is automotive, transport, marine, with 5 deals in it. We have one that we describe as water, infrastructure and resources, but in WA, it's easily described as mining services. We have 2 deals currently in that platform and 2 more that will be closing very soon. And a third platform that will be facilities management. So, and I think what's unique about our structure and to date is that we have now partnered with a private debt fund from the east coast of Australia. We utilize them on all new platforms and all new deals. And the premise of the private debt fund is to allow us to use some more flexible debt than more of a traditional bank early within the first 36 months. And we did the first deal with a more traditional bank. And although it's been great, there are a lot more covenants and restrictions on what you're able to do, debt financing, equipment financing, etc. Whereas the private debt fund gives us the flexibility in those early stages to acquire more inventory, to buy more equipment, to expand or do what we do. And we found that to be quite a good process for us. And then what we do is 100% of the equity that we do need to raise for each new platform, we do upfront, and it comes 100% from investors. So investors put in all of the equity needed for a new platform, and then the equity is split 50% to RBO Group and 50% to the investors. So the structure of each platform is that equity money comes in up front. We acquire 1 cornerstone at least in a new platform. And then based on a debt covenant to an LTM EBITDA figure, we're then able to acquire in the future at 100% debt. So we probably have a higher debt level than probably what most would have from an acquisition perspective, but we generally sit somewhere around a 2.5 times multiple on our debt leverage to LTM EBITDA structure. And that's because we buy well. So across the 10 deals, we will have on average brought at a 2.5 times multiple across all 10 of those deals.
Unreal. I want to talk about this very soon. These structures and all that, it's a bit of my weakness. So that's why I want to ask. You said now you're able to raise 100% of the equity from investors. Is it because of your track record and everything? And how was it on a first?
So we did it the same way. So we've done 50-50 every single time. So when I conceptualized RBO Group, I didn't want to go the traditional 2 and 20. I didn't think that was appropriate. And again, I don't think there is any wrong way. So anything I say here is purely just how I thought about it and how I believe is the best execution for us. But so I thought that model was fine, but it wasn't how I wanted to execute. I'd also experienced New York City. And for anyone that hasn't been to New York City or lived there, obviously finance rules in that city and they control everything. And I think what the finance world has done a very good job of is build a belief that money is the most important thing in every deal. And although it is important, money doesn't make a deal. Money doesn't save a deal. You can pump 10 million into something and you can still blow it up. So we had a lot of deal origination and there was always a lot of money, but the thing that was missing was always the execution and operational experience to be able to do that. And that's where we fit. And to me, there's a lot of work in that. Anyone who's run a business and not just done it from an investment passive standpoint, or even just sitting on a board from an experience, and I've been there myself, running businesses is a lot of time and energy, and it's a lot of effort, and you deal with a lot of roadblocks and headaches. And for us, we thought when we did this at scale, that was worth the 50% that we effectively charged to do that. Because we buy well and because we're buying SMEs, the returns are still very, very good, and investors aren't necessarily finding them anywhere else in the market, and that is what our investors are attracted to. I think that probably the only difference between the first deal to the last probably 9-10 months this year is that when we first started, like everyone, we probably would have taken any check. Like, we wanted to get the deal up, and fortunately we didn't need to, but we would have taken just about anything. Whereas now we are very much focused on our people. So we don't really have any issues raising money for each new platform now. But we do turn some individuals away, and purely that's just from a fit basis. We're always bringing in new capital because we think that the network effect and the ability to have other people locally and otherwise within deals helps. But we are more looking for our people than anyone now. It's about finding the right, and I think that's probably the number one thing I would say for most people trying to raise money is, we do really try to single into finding the right individuals who get you. And if it's hard at the start, it's going to be hard all the way through. And we have some really, really good investors that back us. They understand what we're doing. They understand the permanent hold co approach, the long-term focus. We always like to say that, look, we think in decades, and we really do. We buy these businesses to continue succession, and we really mean that. Does that mean we don't have an exit strategy? No, we obviously do. And I think that the new platform approach really allows us to build a portfolio of companies within the industry that probably gives us a medium to long-term exit strategy. And how we think through that is that we have this, what I've described as our 2, 5, 10-year strategy. So the first 2 years of any new acquisition is stabilized revenue and profit growth. So for us, that just means come in and build some basic systems that really allow us to make that stable and predictable. The word I use constantly is predictable. We're not looking for hockey stick growth. We're really just looking for stable and predictable. The years 2 to 5, or within those first 5 years, we're looking to build a sellable asset. So that is bring management team in place and instill the RBO Group operating system. And if we can do that, years 5, 10 plus, we are for sale, but we're not necessarily on the market. And what that means is that we'll continue to acquire and roll new acquisitions in. We'll continue to grow and build team and build profitability. But it would have to be a significantly good number for us to sell out, based on the fact that this was originally designed as a cash flow business model. And I think it can always be that way. And then I think from there, it's just about executing well. And like I've said, business is business. It's always challenges. Like every day you're dealing with something different, and it's not all shiny and bright. But that's we've got a group that have either been in business or that have been operationally in SMEs before. So everyone understands that, and that's why they're here. And we've got a really good team. And our team now at RBO is 10. We're going to be focusing more from this point onwards, growing more team at platform level. So like, for example, our CFO and CMO are probably doing the job of 10 people right now. So we're going to be instilling financial controllers at platform level, marketing people at platform level, and really taking some of that in the weeds burden off the key executives and pushing it back more into the internal teams of those platforms as well.
I really like the 2, 5, and 10 model. If that's fine, I'll probably copy that and use it as well. You said you are like an operational and execution guy. So just to be clear, you were able to pull it off by raising 100% of the equity from investors, and you do all the work, you and Matt and the team, and you get 50% carry, right?
Yeah, and that's how we do every deal. So we're opening this new facilities platform now, facilities management platform now, and that it's still under the same structure. And that's the same structure that we'll be going with going forward.
So that means you're not only execution and operational guy, you're a sales guy. So how on earth have you been able to pull it off on these terms?
So I think that maps all the way back to the first business I brought, and I think I've told this story before, but that first mentor of mine taught me everything about sales. So before that business, I don't think I could talk in front of anyone, whereas now I'm much more comfortable in that position. And I don't know if I can give you any secrets about what I do, but mostly just from the experience of doing it for now nearly 15 years. I think for me, the first part of my career was more technical. So learning like marketing and how to run Google ads and all that type of stuff, where I was taught human behavior and psychology in sales early, but I probably spent the last part of this professional career more digging and learning about that than anything else. And I think that helps a fair bit.
I think it really comes down to those having those big balls to really willing to ask the big questions. What I mean in here is I was discussing all those deals when I first got started, but then I read about and I talked to people on this podcast that there is this thing called seller financing. And I didn't know about this, and the founders they don't know about it as well because they are similar to the people who you've been talking to. And one time I went like, would it be fine if we do it like 70 to 80% seller financing, so I could I don't need to take a loan from a bank? And he was like, yeah, sure. And I was like, okay, that's how it works. You just need to be willing to ask those so-called big questions.
I think you're totally right. I think this maps back to the conversation before about just getting a deal away. But I think the one thing I've learned over time is there's no rules, right? Like there really is no rules. Like everyone told me when we first started, no one will ever say yes to you taking 50% carry. We are now effectively in a position where I don't think we'll ever do it any different. I think it's the same with anything you can structurally put together, and sales is one of them, is that like cold calling. I continually have my wife say to me, you can't just do that. You can't cold call. You can't do this. You can't do seller financing. But if you don't ask, you're not going to get it. But I think that's probably the biggest point. And seller finance is a good one. We've just done a deal recently, which I know I mentioned to you about, was cash flowing over 500K a year. We did the deal for 850 and we did 400 up front and 400 on seller finance. So pretty much half. And that was just because we asked, right? He effectively wanted it all up front and we asked, and we had the means to do it. But obviously structurally for us, it was better not to do it that way. So yeah, I think you need to go in as aggressive as you can. But that said, our position is always build trust up front and build that rapport and spend the time necessary to get to that point. You can't do that in the first meeting. And that has gotten fundamentally easier as we've progressed, got more momentum, done more deals, build a better structure, had a bigger team. And our big focus right now is to stay that way. Like I said, we didn't have any of this structural skill set last year, and we've gone to people to see how we should structure the business moving forward. So on the back end, we're acting more finance, private equity type driven, but we want to be that more family run, structure focused, because I think it is important. And it's not important for us to do deals. I think it's important for us to continue to build these businesses the way that they were built, just with more sophistication, systems and optimization built into them over the long term.
Acquisition multiples. You said the group average has been 2.5 times so far, and one of the deals you doing or you did was company does 550K net profit, and you were able to acquire it for 850K, which is less than 2 times earnings. Another question: how is this possible?
It just honestly, it's what you said before. You just have to ask. I think you need to understand the market. You need to understand why you're going to offer that, and it's also positional based on the seller. So it depends on where the deal comes from, how sophisticated that advisor is, if they do have one, timing. I think the thing that we have learned to probably be the most important thing, bar none, is price is the only thing that matters. If you get price wrong, it changes everything. It changes your forecast, it changes your execution, it changes hiring, it changes everything. And that change might just be time. If you pay 5 times instead of 3 times, you may need to do things much quicker than taking your time to execute well. So we have fortunately was given the advice late last year and by one of our key advisors, and we try to follow this as much as we can, that deal discipline is the most important thing to concentrate on. And that, I think business contradicts itself all the time. And I think I just did with what I said before about getting the deal away. But I think for us, you need to get a volume of deals to get enough deals to look at to do that first deal. And then that'll give you the opportunity to knock away the more expensive ones. But again, I think it's, situational to your environment. So we're in a geographical location where traditionally multiples are lower. We're below those traditional multiples anyway. But if you're in the east coast of Australia, you're probably 3 to 5 times, and probably more likely 4 to 6 times versus where we're at, between 2 to 4 times. So I think you still need to make it geographically appropriate. But there are deals out there. You just have to be willing to look for them and put in the time and effort. Like, we do a lot of work in this space. We see a lot of deals. The thing that we've built now is a financial analysis model where all we need is 3 years of financials and a balance sheet. And we can very quickly, within 24 hours, spit out enough of an information set for us to make an appropriate offer. And generally speaking, if we see a deal that fits, we move very quickly. We generally have an MBAO in place within 48 hours, and then we enter due diligence. So yeah, we've built a lot more speed around that part. But understanding the market and the data and having conversations will teach you a lot about that as well. The most important question I ask at every first meeting is, what's important to you in this deal? And the seller will generally give you the answer, right? They'll tell you, is it time? Is it money? Is it family? Is it team? Is it something else? And it may be a combination of all the above. But that is the key question that we ask. And the second question that we ask, and it's more for us, but it does build a level of trust, is these owners know more about the business than you ever will. They've been in it for 20, 30 years. So the second question at the end that we ask is, if you had 10 or 20 more years, what would you do? And that tends to build out our execution plan. And we look to execute as much as 80% of that. It's not everything. We don't do everything they say, but mostly what you'll find is these owners have got a handbrake on their business, and it's for a number of reasons. It could be age, it could be comfort. We're actually finding a trend now here that a lot of people get to capacity because early on in their business life cycle, they buy the building they're in, and then they have an emotional attachment to that building. So when they're about to outgrow it, that's where they stop. They don't want to move. They own the building. They want to stay there, and then that's just where their business stays. And that might be a 5 million revenue, might be 10, but we're actually finding that trend as becoming more significant now in deal flow that we're seeing.
I want to talk about post-acquisition, what you do, and how much work it really requires. The 2, 5, 10 model, the first 2 years. How has it?
So we have another kind of framework for that. So we have what we describe as our 3 life cycle stages. So the first life cycle stage is acquisition, and that's everything up to completion. From completion, we then have a life cycle stage, which is described as integration. And then post that, it's just operating, which is just general day-to-day business operations. So integration, we have a mindset of up to 90 days. And I say up to because each business is different from a size and structure standpoint. But we always say we want to keep as much as we can as status quo in that first 90 days because we're doing handover, we're learning. Now, that doesn't mean we don't change anything because in some businesses, like the one we just acquired, there was really no website, there was no sales funnel or anything. So we really had to make some changes. But we spend 2 periods in DD. One is the general DD that anyone would do, and the second is building what we call our assumptions list or our framework to what we believe needs to happen. But we generally try not to do that, like I said, depending on the business, up to 90 days. Now, we may get into a business and after 30, we've completed handover, the seller leaves, and then we can start to move and change. But I think one of the key learnings that we've learned the hard way is that communication is critical. And I'm talking communication to all stakeholders. So employees, suppliers, customers, and even the smallest of changes can be big to each of these stakeholders. And that could be changing the Wi-Fi, that could be logo change, that could be anything. Because again, people don't like change, and there's new owners coming in, and they don't know what that means, and it means to them instability. To us, it's exciting, but I think we've learned the hard way that could mean instability. So we spend as much as we can on that. And again, it's very hard because everyone's itching to make changes. And we've been through experiences where we have made changes quickly and then where we haven't. And yeah, each situation is different, but that's kind of our framework and what we look to. And then the goal by the end of that 90 days is to then build the next 12 months of what our structure looks like and our planning. But we do that in a thought process of every 90 days, we're willing to change it up. Because when you're acquiring a business that has no management in place or succession and no real systems or processes, as you start to bring in new tech, as you start to bring in new systems and new team, things do change quite quickly. So therefore, what you planned 60 days ago may or may not be relevant, and you need to be willing to move and adapt to that as well.
A bit of off-topic question: when you acquire this business, the ones you've did, do they own the building? Do they own the warehouse, or how do you structure this? Because this is there. I talked with one guy who does the same thing in Los Angeles, and the building is oftentimes worth so many more times than the business
Yep.
itself. So
So
how is it
we've
there?
never acquired the property to date. We do have a future thought process around having a property play around what we're doing as well, especially now that we're acquiring more and more, but we haven't to date. We've probably had a mix somewhere around 50-60% of owned and the rest haven't. We do now look to put first right of refusals in all the new lease agreements to acquire the property if they are ready to sell. And if one came up today, depending on the opportunity, would we? It would just be based on that business. But we haven't today, and I think it's a different strategy, it's a different investor set, and it's a different structure. For at the moment, we're really concentrating on business acquisitions and doing that.
What about the founders again, post acquisition? For how long do they stay, or how has it been? I mean, you ask for this 10-20 year plans. How has been the reality of actually executing this plan? And is it with the founders, without the
It's
founders?
without the founders, outside of handover. So our mandate is that we generally do handover between 1 and 3 months, depending on the complexity of the business. And if we always sign the owners to contractor agreements. So if we do need them in 6 months' time or 9 months' time for a day or two here and there, obviously they're compensated. However, our mindset around this is that if we do need the owners for longer, it's probably not the right business for us because it has too much key man risk on that one or two individuals. So we wouldn't do the deal. Within that, I think because we're buying off retiring business owners, putting together a deal that says, hey, you've got to stick around for 1 or 2 years doesn't fit their plan. So again, going back to if they need to be there, it's probably not the right deal for us. And then on the flip side, they want to get out. So our goal is to structure an integration plan as swiftly as we possibly can to extract information, do handover, and then kind of move them on as quickly as needed as we can.
Any stories about raising prices for those products and services post acquisition, and maybe what
Yeah, so
happened?
that is probably one thing that we believe most owners get wrong, is their pricing is too low. We've had multiple different scenarios where owners have said, don't raise prices, customers will leave. And we haven't immediately raised prices, but we have. And you get some attrition, but not anywhere near as much as what they said and not enough to affect the business. So pricing is definitely one strategy that we look at quite effectively through due diligence and see where the market's at, where we're at. And what we could do in the short and medium term to obviously widen our margins from that perspective. We don't, however, build that into our model when we're modeling. And look, I think models are good to some degree, but I think it can get people to lose focus. But we don't build in new pricing. That is something that we just kind of say is a cream on top if we can effectively execute that. But we have found to date that it is something that we do.
I mean, those businesses obviously a bit risky to acquire. With your experience, probably less risky because of this key man risk. Now, as you have more experience, you've done many deals, you've seen a lot. Has there been any cases where things are like you made a mistake? You're like, it's so hard. You're spending so much time on it to fix the business, to grow the business. Because again, I talked with one holding company builder, and they said they have like 6-7 companies, and one company is struggling. They made a mistake with this by actually acquiring it in the first place, and now they're spending like 95% of the time on this, when they know that their other 6, if they would put their even 30-40% of time on these, they would just grow so much, but the one affects it all. So how has it been for you?
I don't know if I would say it's a mistake. I would certainly suggest that there are companies at certain times that take more bandwidth than others, and then you're distracted from those other businesses that maybe could be flourishing more than what they are if you had spent the same amount of time. I think the biggest thing that affects that, in my view, is people. And we're spending more and more time on executing better on the people side. So that's either hiring, communication to existing employees, training, and what that looks like. I think the fortunate thing that we have within our platform structure is a level of that responsibility has changed between it being RBO's responsibility and the general manager within that platform. So a lot of our focus for our general managers is on operations and people. And they're really the two key things that they need to be skilled at and work on every single day. And then we have the shared services model built around the rest of the capabilities or departments, being finance, sales, marketing, IT, operations. But for an example, we're even discussing internally now, do we need a chief people officer, and what does that look like, and how would that roll out throughout the entire group structure and all of the companies? So I think probably most of the mistakes we've made have been around people. And I'm not saying about bad hiring, I'm just saying how we have executed with team or managed or communicated down, whether at the start or throughout acquisition. But yeah, I think it's only natural to think that one business will at some point take more time than the others. And I think that's why we have such a good executional team that we can dedicate resources to that. And does that mean you have to put on pause or allow another business to solve? I think the answer is yes. But that doesn't mean they don't thrive long term. And I think, again, it really depends on what is your incentive structure, and that'll kind of tell you what your output is from that. And for us, it's long term. So if we need some short term slowness in a quarter or two within a certain platform or a portfolio company, we're willing to do that for the greater good of the entire structure and making sure that everything works well.
How does your days look like now versus when you had a smaller portfolio and when you just got started?
They're certainly busy, but I will admit that, I don't know, I've got some teams sitting around me, but I certainly would say that my team's a lot busier than probably I am, if you wanted to count all the hours. We all have our roles, and I think that we wouldn't be able to do it without our team. And we have some really good people, passionate people about what we're doing. They understand what we're doing now and what we're building towards in the future. But yeah, I think when I first put this together, I'd been in business over a decade. I'd worked long, crazy hours in and out of those different timelines, depending on when and what was happening. I wouldn't say that I built this or wanted to build this for a lifestyle business, but I do structure my days around personal life as well. And that may mean that, hey, I'm up to 11 o'clock, 12 o'clock because I leave to pick my son up from school, or I do hours at home. But we do whatever is necessary. I think you have to. I don't think you can do it any other way. But we are certainly busy. And as I said before, I think everyone in every role is probably doing 5 to 10 people's roles at the moment. And that's something that we're managing. But again, because of our mandate of being predictable and stable, we're still growing. Each company is growing, but no one's expecting 3x numbers in every 12 months. So I think it's expectations. And I think that probably comes back to one of the biggest mistakes you're talking about. I think the one thing that we're trying to concentrate a lot on now is setting expectations across the board. Investors, it's why we have really good investors, because we set clear expectations. Our employees and our staff, we're trying to do a much better job on that early, and then internal team and the like. So I think setting expectations is a big focus for us, especially for myself. Because the clearer you are with that, the easier it is for everyone to understand where they stand or what needs to happen from that perspective as well.
What are your thoughts? I mean, now you've seen a lot of different businesses. You have 3 platforms on your own business. What are your thoughts when it comes to, let's say, focusing on this one specific platform and growing this instead of just growing 3 and keep buying businesses in other industries?
This is a conversation we have every day, which is why I'm laughing. So I think my internal team would love for me to stop finding new deals and concentrating on the platforms we have and executing just them. What I have found in market at the moment is that a lot of sellers were ready to sell in the early 2020s. COVID hit. It didn't allow them to sell through that period. So they're 3 years older, they're probably 3 years more tired. They're at an age of retirement. So we're finding, especially in our market, that deal flow is increasing from a supply perspective. So there is a lot of deal flow. And then I come back to just the simple math of, if there's a lot of deal flow and these businesses are once in 20, 25-year opportunities, does that mean that we're missing out on them? But that also means that we're building a lot of structure and a lot of team. So when I first conceptualized RBO, and as I said before, one of my key criteria was products over service, because I wanted less people. And now I've got over 50 employees in the group. I've got 10 at RBO Group level, which I'd never even thought I would get close to. So with that mindset comes change, and I think you have to accept that. And I feel as though that in this market we've built somewhat of a moat. I feel we have an opportunity to increase the size of that moat, and we have really good people around us, both locally and nationally, that are supporting us doing that. So again, I think the mandate has changed just because of what has happened and how fast it is. And again, going back to the start of the conversation, my risk tolerance is high. I have a very optimistic mindset. We have some very smart people around us who bring that back. We have some really good deal discipline. We've got good people and groups doing DD for us, both legally and financially. So we're eyes wide open, but we very much are on a path of acquiring really long-standing, stable, profitable businesses. And if we keep finding them and they meet the criteria, to date, my mindset has been, why wouldn't we do it? Not why would we do it? Why wouldn't we do it?
How much have you had to change or improve your mindset when it comes to delegation? I mean, you have a lot going on, a lot of portfolio companies, a lot of small problems. How
That's
has it
probably
been?
been the biggest thing to change, because if you don't, you couldn't do it. So you just have to put trust in team to be able to do that. And I think that's the level that I've got to now, where probably even 5 years ago, I probably didn't have that mindset. And it's probably the only way for us to get to this point and to go beyond it as well, I think.
Few more questions. What are maybe the biggest challenges for your business and portfolio companies at the moment?
Team, definitely number one. And that's across the board of what I've already described. I think we're in a market that, and I think there's a lot of markets out there that are struggling from or finding the right people, being able to afford the right people, and then obviously setting expectations and communicating appropriately so that they're all on the same page. I think in the businesses that we're in as well, and I've said this a few times, everyone's doing probably more than their job description. So really buying into that vision is important. So I think team's number one. I think probably the second biggest thing that we're working towards, and it's probably just a challenge, is the ability for us to create our operating system fast enough. So we have never been, and I have never been, a guy that will sit there and plan everything out and then execute. We typically sprint and then build behind that, which makes it hard, right? Like, we've got 10 companies, we've got a general framework of an operating system, but not every single detail of that is documented. So that has probably been our next biggest challenge. And that relays back into challenge number one, right? Like, as you're running and building, is everyone around you been in that position before, and are they comfortable with that? And not everyone is, but that's our business model, and that's where we're at. And we are creating our own problems by acquiring businesses as well that don't have any of these systems in place. Actually, we've looked at a couple of deals recently that roll into existing platforms that are more sophisticated from that operational standpoint, and that has been fine, because now that we are growing, we can plug one or two more of them in, and maybe we pay 3 times versus 2.5, but we don't have to put as much team bandwidth in, and we can let them operate as usual for a period of time. But yeah, so I think they would probably be our two biggest that I can think of right now.
Will you ever consider acquiring a business in Melbourne or Sydney, or your just core focus is Perth because of the acquisition multiples?
Yeah.
And
For now, I can't say never, but I think Perth is the most appropriate market for us. We're here. It fits everything that I described from our mandate perspective. And look, Perth's a great location. Western Australia is a great location. It's great weather. Everything else. I did remote work when I first moved back from New York, and it works. But from an SME standpoint and how we're executing at the velocity we are, it would make it different. And I think it would change the model slightly. And does that mean, is that team, is that acquisition criteria? I don't know. I haven't put enough thought into it. So yeah, Perth is the focus.
yeah, I'm asking because I used to live in Australia,
Yes.
Melbourne, and I still have my Australian map here. It's a mouse pad pretty much. What we talked about the 2-5-10 framework. I want to know on a whole goal level, what is Nigell's goal for year 10? How big you want to grow it, or what's
I think that how big, I honestly have tried to put some thought into this, but a month in our world is a long time because we tend to acquire quite quickly. So I would say it's going to be significantly bigger than it is now. Year 10, I would like to think that we still have held for that period of time. We've built the operating system, teams more sophisticated and deeper, and we're executing well. Reality says that with the pace that we're moving and even the conversations we're already having, that a platform or two will get an offer to be acquired. And do we execute that? My mindset right now is that it would have to be a very, very, very attractive multiple. Because if we build consistent cash flowing businesses with the right systems and people, that why would we sell them? And then everyone always then asks what happens at Topco level, at RBO Group level. To date, we always get asked to invest at Topco level. We've always said no. We haven't had to date. We've funded it to date through all different means, but will that change? I don't know. Do we sell it at Topco level? I don't know. Would I ever go public? I think I'm very clear on that one. The answer is no. I think if we ever got to that stage, it would probably be my time to leave at least. But again, things change pretty quickly, so that might change as well.
How has building RBO Group changed your life and changed your family life? Comparing this Nigell today with one who just arrived from New York City with the idea of settling down in Perth.
I think in 2020, coming back from New York, the whole world was really unsure about what was happening. So at that time, I think I was very unclear. My biggest question when I moved back, and this was also most people around me knowing my personality being quite fast paced, was how was I going to find the transition from New York City back to Perth? Obviously, it's much different. It took me, I believe, 9 months to kind of get settled. I kind of still remember the day that I went, I think I'm comfortable now back here. I was itching for that first 6 or 9 months to move somewhere, whether it be back to New York or somewhere. But obviously with a young 3-year-old at the time and coming into school age, we decided not to go. How has this changed? I think at the moment, we're still early. And we're really in the infancy of RBO Group. Like, even though we've done 10 deals, like realistically, that the first one was March of last year. So we're probably just coming up towards 18 months of this journey. So I'm still working as much as probably what I was before. Monetarily, it's good, but again, we're still in its infancy, so that's all still playing out, and we haven't exited and won't be looking to exit. So, but what I would say is that I'm probably having the most fun I have had in my entire business career, so 15 years. Now, some days I wake up and go, hey, like, why don't I take the easy out and do something easier? But I then wake up the next day and I'm back to where I feel like I'm comfortable and I'm having a lot of fun. But that's, I think, just a normal business journey. So, no, it's honestly good. I think, again, we live in a geographical location that's got very good weather. It's got great beaches, and and it's a good spot to be.
Awesome. Let's wrap up with a famous 5. How old are you?
39 in December.
Favorite book?
I don't know if it's favorite, but it's one I always think of, and I actually just coincidentally downloaded it on Audible again last night. Is Daniel Canahan's Thinking Fast and Slow. I really like that book.
What car do you drive?
Tesla Model 3.
What's the best investment advice you've ever got?
I don't know if I would ever say I could pick, I think, the best investment advice. I think something that I've probably learned is that what I'm doing now and focusing on cash flow is probably instrumental to anything. It's up until this part of my career, I've always focused on growth. I think everyone does. Everyone wants to create a startup and hit a big payday. It's very difficult, obviously. and a lot of people are headline readers. And I think that's probably what I got that advice from someone about not being a headline reader. And I think as soon as I moved away from that, it kind of changed my mindset around really focusing on what can be done. So I don't know if I have one single best bit of investment advice. And honestly, I don't think there is, to be honest. I think it needs to adapt to your lifestyle and what you're comfortable with. And for me at this stage of my life, this is it. So, but like I do, as everyone does, everyone focuses on Warren Buffett and all of these greats. I think, look, I'm a big fan of Bill Ackman. I think what he's done is fantastic. Obviously, Warren Buffett, everyone loves, and a part of this strategy is based on that. But most of what I do isn't original. Every time we find a new industry or concept, I look to the US mostly straight away. It's generally already been done we look for best practices and how we can emulate and model that, and then we try to do it as effectively as we can.
Nigel, it's been a lot of fun, and personally, I'm very happy that we
so am I.
can't say got to know each other, but happy that we connected, and I will be the one asking tons of questions for you in the future. But if there are some others wanting to reach out to you, where can people find you?
Probably the easiest is either LinkedIn, and I'm happy to share that with you, and please DM me, but probably the RBO Group website, which hopefully by the time this is released, the new website is up, and reach out there and just mention maybe in the comment box that you listen to this and you have some questions. Happy to connect. Again, I think I don't ever say we have all the answers. We sound pretty confident most of the time, but we are always bouncing ideas and trying to leverage off other people and learning. And I think it's the only way to go. So happy to help where we can. And we are, as you probably have seen here, we're a fairly open book. We don't have any secrets. Execution's execution, and everyone does it slightly differently. And there's enough deal flow out there, I think, for everyone to do it their own way. So that's why we share as much as we can. Awesome.
It's the longest podcast I've ever
I told
done,
you it would be.
Thanks for doing this.
Yeah. Awesome. Thanks, mate. Appreciate it.